My name is Michael Levy. I'm a co-director of the PASS program. Before you watch this excerpt, I'd like to tell you a little bit about the course we developed for CFE Indian and Other International CAs. This course is a very comprehensive course, which was designed specifically to meet the needs of Indian and other international CAs who did not complete their studies in Canada. The three main hurdles that international CAs face are the following. Number one, they need to get up to speed on their technical, not having ever studied Canadian tax or Canadian accounting in their home country. Also, a second hurdle, even if you did study certain topics that have not changed very much, such as, for example, management accounting or finance, topics that are the same whether you're in Canada or India, we find that many Indian CAs have forgotten these topics, given that they wrote their exams many years ago. Most importantly, many international CAs were never exposed to case writing. And case writing is an integral part of the Canadian CPA exam. The final exam, called the CFE, is purely a case-based exam. So this is a skill that Indian CAs and other international CAs need to master before they can pass this exam. PASS has a great deal of experience working with non-Canadian students and has built into the course for CFE Indian and other international CAs extensive case writing and technical training in all of the competencies examinable on the Canadian CPA exam, so that an international CA will not be at a great disadvantage when he or she writes the CFE. This first excerpt is from the case writing portion of the course and provides a demonstration of how PASS teaches international CAs to write cases effectively. The second excerpt is from a technical review session. We hope you enjoy watching these excerpts. Let's take a look now at investment in associates. This topic is covered under international standards, under IFRS, under IAS 28, investments in associates. Under ASPE, the topic is covered under section 3051, investments. An associate is an entity over which an investor has significant influence. The term that's used under ASPE for an entity over which an investor has significant influence is investee. So the term investee and associate mean the same thing. One of them is an IFRS term, associate is an IFRS term, investee is an ASPE term. The presentation I'm about to go over is based on IFRS. Any significant differences between the two are highlighted. Thankfully, for the most part, they're very similar. There aren't going to be a huge number of differences. When you're dealing with significant influence, some people make a big mistake. They immediately fall back on the guideline. There is a guideline that says that significant influence normally exists if an investor owns between 20 and 50% of the voting shares of the affiliate, what we're calling the associate or investee. So there are some candidates where if A purchases 22% of B, they assume that A has significant influence over B. If they purchase 18% of B, they assume they don't. That's a huge mistake. Please keep in mind that the 20 to 50% rule is nothing more than a guideline. On a CP, and this has come up on the CP, on a CP, what you need to do in deciding whether there's significant influence is determine whether there are indicators of significant influence present. These would be examples of indicators of significant influence. So what I would do is I would go back to the case facts in the case, and I would try to tie back to some of these variables to determine whether there's significant influence. You're not going to likely ever find a case where every one of these variables is present, but some of them may very well be present. So for example, if A holds only 18% of the shares in B, okay, they hold less than 20%. But let's say A has major representation of the board of directors of B, or let's say they're very involved in the policy-making process of B, or let's say A is a major supplier. A only owns 18% of B, less than 20%, but they're a major supplier to B or a major customer to B. Wouldn't you all agree that they probably have significant influence, even though they only hold 18%? Interchange of managerial personnel would be another example. Or let's say A provides a lot of financing to B. So B is very reliant on A for financing. I would guess A would have significant influence. So at the end of the day, guys, it's really common sense. If there are factors present that would indicate that A should be able to significantly influence B, I would try to tie back the case facts to those factors to demonstrate that significant influence exists, even if there's less than 20% ownership. It's a guideline only. In real life, there's lots of situations where one company owns less than 20% of another and has significant influence. The reverse, though, is also true. You could have a situation where A owns more than 20% and still doesn't have significant influence. I'll give you an example. A owns 25% of B. The other 75% is owned by one family, and that family calls all the shots. And A really has no influence whatsoever on the company. Even with a 25% share, they may still not have significant influence. Now, why does it matter whether A has significant influence over B? Why does that matter? If A has significant influence over B, what would the method we use be? What's the method we use if A has significant influence over B to account for the investment? Can someone tell me? Excellent. You would normally use the equity method. If A has significant influence over B, we use the equity method. Now, the equity method is similar to consolidation, except that the significantly influenced company statements are incorporated into the investor corporation statements on a one-line basis. So, unlike the case of consolidation, where we add each of the assets and liabilities of the sub to those of the parent, and each of the revenue and expense items of the sub to those of the parents, that's what we do in consolidation. When we use the equity method, everything is done on a one-line basis. The parent picks up the investor picks up its share of the associate / investee on one line, which we call equity income, and also on one line in the balance sheet, which we call investment in whatever the company is. So it's similar to consolidation, but it's all done on one line. However, we still have the same adjustments we would have for consolidation. We still have to worry about fair value increments and depreciating or amortizing those fair value increments. We would still calculate goodwill. The goodwill would simply be buried in the investment account, but we would keep track of it. So if there's an impairment of the goodwill, we could have a write-down and an impairment loss. So at the end of the day, we still also have intercompany transactions and unrealized profits that have to be eliminated. So it's very similar to consolidation, but it's all done on one line. So at the end of the day on the income statement, instead of adding the investee's revenues to those of the investor and the investee's expenses to each of the investor's expenses, on one line, we pick up equity income. Let me give you an example. Let's say the investor purchases 25% of the associate and uses the equity method. Let's assume the associate's income is $2 million. I'm going to show you how the equity method works. At the date of the acquisition, let's assume that the associate has a building with a carrying value of $1 million and a fair value of $5 million. So there's an increment of $4 million. Let's assume the building is being amortized over 40 years. In using the equity method, the investor would pick up their share, 25%, of the investee or associates, it's the same thing, the investee / associate's income. The investee's net income is $2 million. So the investor would pick up 25% of $2 million, which is $500,000. But the investor would then have to adjust for the same things as for consolidation. So just like if we were consolidating, we would have to take amortization on the fair value increment. We would have to do the same thing when we use the equity method. So the fair value increment was $4 million, the difference between $1 million and $5 million. The building has a fair value increment of $4 million and it's being amortized over 40 years. So amortization of the fair value increment would be $100,000. Now remember, the investor only owns a 25% share in the investee. So the investor's share of the amortization of the fair value increment is 25% of 100K, which is 25K. To calculate the equity income that the investor would recognize in its income statement, we take, the investor picks up its share of the $2 million, 25% of $2 million, and then the investor subtracts its share of the amortization of the fair value increment, and this would be the equity income that would appear on the financial statements of the investor. We're going to end up with the same income whether we use the equity method or consolidation, and we're doing the exact same adjustment. The only difference is we're picking it all up on one line when we use the equity method. Now, any questions? And okay, Wasim asks, what is the treatment if you have less than 20% and no major influence? Excellent question. You would use the cost method. So you would simply account for the investment at cost, and it would sit on your balance sheet every period at cost, unless there's an impairment, in which case you would write it down. You would not pick up the income of the investee. The only income you would show is dividends. If you received, let's say A owns 15% of B, so A receives 15% of the dividends, they would recognize the dividends they're entitled to as income. That's it. So the cost method simply means that the investment sits on the balance sheet at cost unless there's an impairment, and dividends are recognized as income. If they have more than 50% with no major influence, that's unheard of. That's almost impossible. So I wouldn't worry about that. I'm not even going to address that because that's virtually unknown. Dharmesh, when you ask me what will the balance sheet impact be, what do you mean? I'm not sure I understand the question. What will the balance sheet impact be of what? Okay, now let's take a look at the balance sheet. No problem, my pleasure. On the balance sheet, the investment in the affiliate is reported, and when I say affiliate, I mean the associate or investee, is reported at cost plus the affiliate's cumulative income less dividends received. So let me just demonstrate this numerically, because that's the easiest way to understand this. What we would do on the balance sheet is the following. We start with the opening value of the investment. So when we're using the equity method, let's assume the opening value of the investment based on the equity method is $100,000. If there are any equity earnings, we add those earnings to the investment. If there are any equity losses, we subtract them from the investment. Any dividends that are received from the associate / investee get deducted from the investment account. So our final balance would be opening investment plus equity earnings or minus equity losses minus dividends gives me my year-end balance. If we keep doing this every period, then over time, what we're really doing is, let's say over 5 years, we'll be adding the cumulative income over the 5 years, and we'll be subtracting the cumulative dividends. If we keep doing this every year, right, then over time, we've added the cumulative income, we've subtracted the cumulative dividends. That is how we deal with the equity method for balance sheet purposes. I should mention that on the May 16 CPA, you really have to be comfortable with the numbers for the equity method. You have to calculate fair value increments, goodwill amortization, equity income, the year-end balance, basically everything we just talked about, you had to do on the 2016 CPA. Year-end of investor versus associate. When the end of the reporting period of the investor is different from that of the associate, the investor prepares financial statements as of the same date as the financial statements of the investor, unless it's impracticable to do so. Let me explain. Let's say the parent has December 31st. Okay, it's very hard to write with this, I apologize. The investee / associate has a November year end. So the year ends are not the same. So what I'm saying in the first bullet is, if it's practicable, for the purpose of applying the equity method, we would have the investee prepare special financial statements at the same date as the investor at December, and we would use those special financial statements to apply the equity method. However, very often it's not going to be practicable. If it's not practicable to prepare a special set of financial statements for the investee based on the December year end of the investor, if it's not practicable, then we would use the financial statements of the associates, even though their year end is 1 month off. It's November instead of December, even though it's different from the investor, but we would adjust for significant transactions between that date and the date of the investor statement. So in my example, if it's not practicable to prepare special financial statements for the purpose of applying the equity method, if it's not practical to prepare these statements for the investee at December, we would use the equity method using the November statements of the investee, even though they're off by a month from the parent statements, but we would adjust for any transactions between November and December. Everybody with me? We would adjust for any significant transactions. Now, the guidance under ASPE is similar. Under ASPE, it says when dates are not coterminous, events relating to or transactions of investee during the intervening period that significantly affect the financial statement of the investor should be disclosed unless these events or transactions are recorded in the financial statements. ASPE is a little bit different than IFRS. IFRS says you have to adjust for significant transactions, in my example, between November and December. ASPE would say you either have to disclose these significant transactions or adjust. So you have a little more flexibility under ASPE. Now, IFRS has a special 3-month rule, which does not exist under ASPE. Under IFRS, you're never allowed to use financial statements of an associate with a year end more than 3 months different than that of the parent. So what I'm saying is the following. Under IFRS, let's say the investee has an August year end and the parent has a December year end. In that situation, it doesn't matter whether it's practicable or not to prepare special financial statements for the investee at December. It doesn't matter. As long as the statements are off by more than 3 months, and from August to December is more than 3 months, it's 4 months, you have no choice. No matter how difficult it is, you would not be allowed to use those August statements. The investor would not be allowed to use the investee's August statements for the purpose of using the equity method. The investee would have to prepare statements at December. The investor can only use the investee statements if they have a different year end if it's within 3 months. Because ASPE likes to keep life simple, there is no 3 months rule under ASPE. Impairment, guys. Impairment of equity accounted investments is dealt with under IAS 36 under impairment of assets. As you probably recall, guys, there are very specific rules when you're dealing with IAS 36. You need to assess at the end of each reporting period whether there's objective evidence that there may be an impairment, right? You'd look for indicators of impairment. So an associate being in financial difficulty would be an example of such evidence. How would you test for impairment? By comparing the recoverable amount. And again, I'm not going to reteach what Ira taught already. If you don't remember this, please go back to the lecture on impairment of assets. When Ira taught IAS 36, he would have explained to you that you would value you would come up with a recoverable amount based on the higher of value in use and fair value less cost to sell, and you would compare it with a carrying amount. If the recoverable amount, which is based on the higher of value in use or fair value less cost to sell, is below the carrying amount, you would write down to the recoverable amount. And again, I'm not going to go through this with you again because it's been covered. Under ASPE, you may recall that when Ira taught the section on impairment of assets, equity accounted investments did not fall under the equivalent to IAS 36. There is a handbook section under ASPE, I think it's 3473, which is the equivalent of IAS 36 under IFRS. That's the handbook section under ASPE that deals with impairment of assets. That handbook section that deals with impairment of assets under ASPE does not include equity accounted investments. So IRA would not have covered equity accounted investments when he was dealing with impairment of assets under ASPE. Under ASPE, impairment of equity accounted investments is covered in the same section as the equity method. It's covered in section 3051, which we're talking about right now. What is the method under ASPE for testing for impairment? Let's take a look. At the end of each reporting period, an entity must assess whether there are any indications that an equity account investment is impaired. When an entity identifies a significant adverse change in the expected either timing of cash flows, in other words, we expect to get cash flows later than we expected, or in the amount of future cash flows. They're now expecting to collect less cash flows than they expected. In that situation, we have an impairment, and we would reduce the carrying amount of the investment to the higher of these two amounts. Please read A and B. I have nothing to add to them. Take a look at A and B. I have nothing to add to them. Okay, we would reduce the carrying amount to the greater of these two amounts. Okay, any questions? Here's an important point, guys. Under both ASPE and IFRS, you're allowed to reverse an impairment loss when you use the equity method. Under IFRS, it's no surprise that you're allowed to reverse an impairment loss because it falls under IAS 36, and under IAS 36, you're generally allowed to reverse impairment losses. So you can write down an equity accounted investment in one period, and you can write it back up the next period if things get better. Under ASPE, if equity accounted investments had fallen under the impairment section, the equivalent, the ASPE equivalent to IAS 36, you would not have been allowed to reverse an impairment. But because it doesn't fall under the impairment section, it's not bound by those rules. It falls under 3051, and under 3051, you are allowed to reverse an impairment loss even under ASPE. So if things get better the next year, you can write the investment back up. Loss of significant influence, I'll let you look at it on your own. I don't think it has a huge probability of being tested, but you can take 5 minutes and read it on your own, please. Losses in an associate, I do want to go over. I think that's quite important. If an associate incurs losses in excess of carrying value, the carrying value is not reduced below zero. Further losses are recognized only to the extent that the investor has an obligation to fund the losses. What I'm talking about is the following. I said earlier that when we use the equity method, how do we come up with a balance sheet value? We take the opening balance and we add equity earnings, or we subtract equity losses. What if the equity loss is greater than the opening balance? The opening balance is $1 million and the equity loss is $1.2 million. Do we reduce the balance to below zero, to negative 200,000? The answer is we only do so if the investor has an obligation to fund the losses. Otherwise, we would only reduce the balance to zero. But we would keep track of these losses that we didn't recognize, and the investor would only resume including its share of associated profits and income after its share of profits equals the share of net losses that were not recognized. I will demonstrate this numerically in just a moment. Now, any losses that are not recognized, any equity losses that are not recognized to avoid writing down the investment below zero, get disclosed. Let's take a look at an example. A Limited purchases a 25% share of B Limited for $1 million at the beginning of year one. During year one, B Limited has a net loss of $5 million and A has no obligation to fund the losses, which means we're not going to have to write down the investment below zero. In year one, A Limited's share of the loss is 25% of $5 million, which is $1,250,000. So if A were to recognize a full loss of $1,250,000, we would be in negative territory because the opening balance was $1 million. If you subtract $1,250,000, you're down to negative $250,000. A would not be required to go into negative territory because they have no obligation to fund the losses. So A would only recognize the amount of the loss equal to the opening balance. They would only recognize $1 million loss and write down and that would reduce the value of the investment to zero. Opening balance of $1 million minus equity loss of $1 million is zero. So effectively, instead of recognizing 25% of the full $5 million, they're only recognizing 25% of $4 million, and they would reduce the investment to zero. Now, A would not recognize the remainder of the loss. They would not recognize the final 250 in year one in order to avoid reducing their investment below zero. But they would have to disclose at the end of year one that there's $250,000 of losses that were not recognized. Everybody with me? They'd have to disclose that. Now, in year two, let's assume the associate makes a $2 million profit. So normally, had A recognized the full loss in year one, had they recognized a full loss in year one, then in year two, when the associate makes a $2 million profit, A would be allowed to pick up 25% of $2 million and recognize a $500,000 of equity income. But because A failed to recognize $250,000 of the equity loss in the previous year, we've got to make up for that before we recognize any equity income. So what would happen in year two is the following. We would take 25% of $2 million, which is $500,000. We would net off the $250,000, which is the cumulative amount of equity loss that was never recognized. In this year, in this case, it's only 1 year's worth. But if it was more than 1 year's worth, we would net off the cumulative amount of equity loss never recognized. And the amount that A would get to recognize in year two would be $500,000 minus $250,000. A would only get to recognize $250,000. A would only recognize the current year's equity income minus any equity losses that were not recognized because of this rule. Now, let's compare this with ASPE. ASPE is not identical when it comes to this. ASPE is actually stricter, which is quite rare. Under ASPE, you need to recognize a loss in excess of the carrying value and reduce the investment below zero if any of these three conditions are met. Either the investor has guaranteed the obligation of the investee, or the investor is committed to provide further financial support to the investee, or if the investee seems assured of imminently returning to profitability. This is a rule that does not exist in IFRS. So if I go back to the example here, under ASPE, if at the end of year one, it was expected that A will return to profitability in year two, then under ASPE, we would have had to reduce the investment to negative territory. This rule does not exist. This rule C does not exist under IFRS. Exceptions to the use of the equity method. And again, what I'm going over now is specific to IFRS. Associates classified as held for sale. Equity method would not be applied when an associate is classified as held for sale. Instead, we would value the associate based on fair value less cost to sell. That's how you account for an asset held for sale. But we would not use the equity method. Point number two is dealing with wholly or partially owned subs, and it's dealing with when you're not required to use the equity method. I'm going to just go over this very quickly because it's very similar to the rules we had for consolidations. Very similar. Let's assume you have a parent and non-controlling shareholders. They own a company called Sub Inc., and Sub Inc. has an investment in an associate. Under what conditions would Sub Inc., when they prepare their own statements, be allowed to not use the equity method in accounting for the associate? The answer is parent and non-controlling shareholders would have to agree that Sub Inc., when they do their own statements, will not use the equity method for the associate. Sub Inc. cannot be public or going public. And at the parent level, the parent has to produce consolidated statements in which they consolidate Sub Inc., and Sub Inc. uses the equity method for the associate. Assuming these conditions are met, when Sub Inc. does their own financial statements, they would be allowed to not use the equity method. Now, separate financial statements, we saw this concept when we were dealing with consolidations. A company may use the equity method for when they have significant influence for their consolidated, let me back up. A company may use the equity method when they have significant influence for their statutory, not consolidated, for their statutory financial statements. But they may prepare a second set of statements, which we call separate financial statements, for another purpose, like tax. At the end of the day, when the entity prepares a second set of statements, we call that separate financial statements for another purpose like tax, in addition to their regular statutory statements, in that situation, or in a situation where they're exempt from using the equity method, like we talked about on this slide, in both of these situations, the company, in place of using the equity method, would be allowed to use either the cost method or treat the investment as a financial instrument. So whether the investor is preparing a second set of statements for tax purposes, for example, or they're exempted from using the equity method in their statutory statements, they can account for the investee for whom they have significant influence using the cost method or treating the investee as a financial instrument. We hope you enjoyed watching this excerpt. If you'd be interested in seeing the remainder of this technical review session, as well as many other technical review sessions on all of the different competencies for which you're responsible on the CFE, please register for the course. If you're not already on our website, please visit our website, passyourcpa.ca. Put your cursor over CFE module courses at the top of the screen, and then click on CFE Indian and Other International CAs in order to register for the course. If you have any questions, both my partner and I would be delighted to speak with you. If you're living in Canada or anywhere else in the world other than India, please feel free to contact myself, Michael Levy, or my partner, Arwa Walfish. You've got over here contact information based on phone, WhatsApp, as well as Skype. If you're living in India, then I would ask you to please contact our affiliate, Orbit, and you've got over here various types of contact information for Orbit. We look forward to seeing you in the course.